So, what in the world does a furniture workshop in Indonesia have to do with the value of the money in your wallet? Well, a lot more than you might think. Today, we're diving into the powerful, invisible force that connects them all, the global currency market.
It's a great question, isn't it? You'd be forgiven for thinking, not much. But honestly, the answer is everything. And it all boils down to the money they use. Okay, so let's kick things off with a story. A tale of two currencies in a very unexpected situation for an international exporter. So, I want you to picture this. There's this fantastic furniture maker in Indonesia. Their business is humming along, they have loyal customers over in the US, their products are top-notch, but then they look at their bank account, and the numbers are just all over the place. What is going on here? Here's the heart of the issue. The Indonesian rupiah has gotten a bit weaker compared to the US dollar. Now, what does that actually mean? Well, it means that for every single dollar an American customer spends, our furniture maker gets more rupiah back home. The effect this has is pretty fascinating. Think about it from the American buyer's perspective. That gorgeous table, it just got cheaper. Not because of a sale, but because their strong dollars can suddenly buy more rupiah. Their money just goes way further. And the result for the company? You might be surprised. Higher profits. It's kind of counterintuitive, right? But because their furniture is now a better deal in the US, they might start selling even more. Plus, every single dollar they earn converts back into a bigger pile of rupiah. So for this exporter, a weaker currency is actually a huge, huge win. So this gets us to the big question. What is this powerful, invisible force that can totally change a company's fortunes, like overnight, without them changing a single thing about their product? The answer is the global currency market, which you've probably heard called Forex. Let's dive in and unpack what that really means. Simply put, Forex is this massive, worldwide marketplace where currencies are being traded back and forth all day, every day. We're talking about a market where over $6 trillion, yeah, trillion with a T, changes hands daily. It's basically the giant global engine that decides what your money is worth compared to someone else's. But here's the thing, these currency swings don't treat everyone the same. It's like a coin with two very different sides, and it all depends on whether you're the one selling the goods or buying them. For an exporter, like our furniture maker, a weaker home currency is just fantastic. Their stuff gets cheaper for people in other countries. But what if their home currency, the rupiah, gets stronger? Well, now their tables suddenly look more expensive to those American buyers, and that could mean fewer sales. It's this constant economic seesaw. Now, let's flip the coin. Imagine a different Indonesian company, one that has to import American machine parts to build its products. Those parts are priced in US dollars, so if the rupiah gets weaker, their costs just went through the roof. For them, a strong home currency is what they're rooting for because it makes buying foreign stuff cheaper. See? Same currency swing, totally opposite effects. So with all this up and down, how on earth do businesses deal with this kind of financial whiplash? How do you even make a plan when your costs and profits could change at any moment? At the end of the day, the real problem is just pure uncertainty. You just can't run a business effectively if you have no idea what your money is going to be worth next month. You need some kind of stability. So, businesses don't just cross their fingers. They use smart strategies called hedging. You can think of it like buying insurance against bad currency moves. A really common tool is something called a forward contract. Our furniture maker can basically make a deal today to swap their future US dollars for rupiah at a specific locked-in rate, maybe 3 months from now. So it doesn't matter what the market does, they know exactly what they're getting. It takes all the guesswork right out of the equation.
But it's not just random market forces pushing these currencies around. Let's zoom out one last time and see who the big players are, the ones really pulling the levers of this global machine.
Believe it or not, governments and their central banks have a massive say in all this. When they do things like raise or lower interest rates, it sends ripples through the entire global currency market. A decision made in a boardroom in Washington, D.C. can directly affect the bottom line of our furniture maker in Indonesia. It is all connected.
And all of this really brings us to one final big question. In a world where the price of your morning coffee or the success of a local shop can be tied to currency markets thousands of miles away, can we really say any business is truly local anymore? It's a powerful reminder of just how interconnected we all are.
Thanks so much for tuning in to this explainer.